In this part of tonight's program on Opportunity Zone Meetups, we are going to deal with the topic of cash exits. So the way the Opportunity Zone tax incentives work is a person who has capital gains from sale of an asset can roll those over into a new investment. And if that investment is in one of the designated census tracts that are distressed and have been selected by the state in which they reside, then they are a qualified opportunity zone. And this then allows the trigger of different benefits that can accrue to the investor. The first one of these is a deferral of the capital gains tax. So if a person earned money in last year, a capital gain that otherwise would have to be reported on April 15th of this year on their tax returns, if they invest that same capital gain over into a new investment that meets all the qualifications, then there will be no tax paid on that gain until the earlier that they come out of that investment or the year 2026. So for the longer term investments, this tax goes for a complete ride with no liability to be paid until the year 2026. If you put this money in and leave it for a minimum of 5 years, your capital gains tax on that amount is decreased by 10%. So where before, if you had, say, $1 million of capital gains that otherwise would have been taxed at about a 25% tax rate, you would have owed $250,000. If you leave it in for 5 years, that's decreased by $25,000 or 10%. So you'd only owe $225,000 when you hit the year 2026. If you then leave it in for another 2 years or a 7-year minimum term, you get another 5% knocked off of that. So instead of $250,000, you're now down to $212,500 because you've had 2 decreases in your tax liability. The big gain that everybody's talking about, though, is that at the end of 10 years, if you put this money into an investment and that investment goes up in value, all that gain in value is tax-free. So again, if we use the example, you have $1 million of capital gains, you put it into an investment. By waiting 7 years, you've decreased your tax liability, but in 2026, you would have to pay that taxes on that investment. But if you bought property with that, and say that property went from $1 million to $2 million, with your investment, that $1 million gain is completely tax-free. And that's the big opportunity in Opportunity Zone tax incentives. The other ones are good, but in the small scale, if you're doing $50,000 or $100,000 in opportunity gain rollovers, you're not going to see a significant amount of money saved through these different things. They're not bad, but they don't amount to that. But if you put it into an investment that increases only 10% per year, which means it's going to double over a 10-year time frame, then all that gain is tax-free. And that's what most people are shooting for in doing these types of investments. So that gets us to the question, how do you get your money back at the end of 10 years? Or what are you doing to arrange to get that money back to the investors at the end of 10 years? In the parlance of the capital industry, getting your money back out of an investment is called a cash exit. It's assumed that the asset, that whatever it is you invested in, whether it's stock or property or something else, that at the end of the investment, at some point in time, you want to get all of your principal or the amount of money you invested back, plus you're hoping to get an appreciation of that investment in the form of interest or an increase in stock value or increase in land value, and you're going to sell that off, and you're going to realize, hopefully, a net gain on that appreciation. So the question is, how does that event occur? Because once you make the investment in, that doesn't mean that there's necessarily an automatic mechanism for you to get your money back. And it's a common practice whenever drafting or structuring an investment for a campaign is to put in provisions that very explicitly allow the investor to know how and why and where and when they're going to be able to pull their money back out of that investment so that they can start doing some assessment of what that exit might look like, how much money they may make, what factors may need to be in place in order for all this to occur. And right now we're seeing a number of projects where there is no fixed exit point. The people put their money into a piece of property, or they're putting it into a opportunity zone business, and then it's assumed somewhere after 10 years somebody's going to do something in order to create a cash exit. Now, it may be that a single investor may decide that they want to sell their stock in a company, or they're going to sell essentially their ownership in the fund, which is holding an interest in that company, and they'll do it in a private transaction. So they'll go out and hunt down someone else who would like to step into their shoes, pay them a price that's greater than what they put into it, and by doing that, they have initiated on their own a cash exit. But there's been no participation by the business or the property to make that happen. There's no mechanism in place for that to happen, and you are subject to whatever market forces are in play at that particular time. So imagine that the opportunity zones have been created back in the year let's get the years right here, 1999, and you decided that you wanted to come out of your opportunity zone investment in the year 2009, okay, when the market is crashing and there's no money anywhere and real estate prices are at the bottom and dwelling, and this is when you want to come out of this investment. You're thinking to yourself, wow, my timing is awful. I don't want to come out of the investment now, and I certainly don't want to be forced out of my investment now. So this could work a couple different ways. You may decide you'd prefer to hang in that investment for a period of time rather than being forced into an exit at the worst possible moment in the valuation of this particular project. So these are all things that are starting, they're coming up on the table now. Is where will our economy be in 10 years? Where will this project be in 10 years? And nobody's got a crystal ball that can tell you definitively this is going to be where we're going to be at in 10 years. We could be up, we could be down, we could be somewhere in between. And yet, as people are getting ready to make large investments at this time, they're asking the question, how's the exit going to occur? When is it going to occur? How much control do I have over this exit? What can I do to improve the outcome of the exit? So one approach to achieving an exit is to wait and see what happens. This is what we call market forces or market-driven exit. And this is where a lot of projects are at right now. We're going to invest in a business. We're going to wait and see what happens. We're going to invest in a piece of property, and we're going to wait and see what happens. There's no contractual obligation. There's no clock ticking. There's nothing there. Now, the way the opportunity zones work is you can put the money in, and you can continue to leave it into the investment until 2046. So you may decide, if the market's bad at 2026 or at the end of your 10-year term, that where you've got the gain is free, you may say, I still don't want to come out because the market's bad right now. I'm going to wait, and then I'm still going to have to initiate some action on my own behalf in order to get out of this particular investment down the road when maybe the market is turned or the market is more favorable. But market exits are very common, done all the time. But if you're an investor, you would like to have a little more control. And the other thing, as I mentioned, is you don't want to be forced out of this investment at the wrong time when the market's not at the point that you want it to be. So then there are planned exits, and there's a variety of ways in which this can be accomplished. And this is built into the investment structure itself. So it would be part of the investment agreement where as the investor puts their money into an opportunity zone fund, that contract for putting the money in will also have provisions built into it, which will talk about how an exit can be achieved. And there's several of these options we're going to talk about as an example what that might look like. Now, one of the things that is being commonly discussed is that the business or the property will conduct another offering at the end of a 10-year cycle. So at the initiation of the project manager, they will go out and do a brand new capital raise over here that will be for the sole purpose of buying out the investors in the Opportunity Zone Fund. And the purpose of this is to give them that cash exit, to allow them to recognize the gains and do it without the tax impact. The question then becomes, who's determining when this offering is going to take place? Because if it's in control of the project manager, they may decide we want to do it immediately after the 10-year time period is met, when everybody's met their 10-year hold period, and that's going to be in the investment contracts that prevents the manager from selling this off at less than 10 years, because if the contract doesn't speak to that, there's nothing to stop the manager from selling the property at 6 years, 7 years, or 8 years and missing out on all this opportunity. So there will be provisions in those investment contracts. Then the question is, well, after 10 years, when can they pull the trigger and do this buyout mechanism? And again, if I'm an investor, I'm going to be asking the question, maybe I want to vote on that, or maybe I want consent before you buy me out of this deal. So if you go raise a fund to buy me out and I don't like the price point, or I don't like the timing of this buyout, maybe I have a right to veto that, or I have a right not to participate in that particular buyout. At the same time, the project manager is thinking, if I can have a very clean mechanism for taking out all these investors, then I am done with that responsibility. I don't necessarily have to continue to care and maintenance of these investors, and it would make my project simpler. So this is a point where there could be a disagreement or conflict between the project manager and the investors. And again, it needs to be spelled out in the investment agreement up front. It may be negotiated after the project's in motion, but that's a bad time to be negotiating for an investor when their money's already locked in. Now, other types of exits can be set up. The Sugar Beet District project, which I'm working with, is we're putting in a buyback option that is controlled by the project manager, but we are specifying the buyback price. So there will be a set amount that would be paid to trigger an option to buy everybody back. So in that case, we're looking at achieving an 8% annualized ROI year over year over the 10-year time period that compounds, and that at the end of that time period, we as the managers can simply notify everybody that we're calling our option, we're going to exercise our option, and we're going to write you checks, and we're going to buy back your stock at a set price point. So for some people, this is very attractive. The option's not a mandatory thing, so it isn't like an enforceable requirement. But if it is exercised, the investor knows that they're going to be getting a rate of return which met their original criteria when they made the investment. So that's another way of doing it. Now, in certain cases, it may be necessary to do another complete capital raise in order to have enough cash to buy everybody out. In other cases, there may be enough cash accrued or put into a reserve account over time in order to buy people out. Again, there's a difference, because if I'm going to do a capital raise at the end of 10 years, there's no certainty where the market is going to be at that point in time. The fact that I want to buy out the investors and the investors want to be bought out may not be achievable under any circumstance, because the market simply is not going to be open to doing that kind of a raise, or this business or property may have suffered in some way where it's no longer at the value that everybody hoped it would be, and it may be unattractive or even unsaleable. So you have the potential worst case scenario. 10 years go by, can't raise money into this project from new sources because this project's gone south. It's not looking good. Now, if it's a capital reserve thing where the money is being put in over time, there's a possibility, even if the project does not experience the upside everybody's looking for, there still may be enough cash to take them out. So it's a more durable mechanism that could be built into this particular type of a planned exit. These are things to be looking at from both the investor standpoint and from the project manager standpoint, because both sides have reasons why they would love to have more control over this, where the market may be working for or against them. And so they may want to also look at options or stacked options where we can do this, and if that doesn't work, then we can do this if that doesn't work. From the investor standpoint, the question is how much control do they have? Is it an automatic option? Is it a one that they can, the investor can say no to? Or is it something that is basically undefined? So we get into the who controls question, and this is a big deal. Timing and approach to how the exit is achieved. So if it's going to be sold, one of the other options is just to arrange for a direct sale of all the components. So it's not like you're raising a fund and then buying out the investors. You're simply providing a showcase or platform where the investors can put their individual ownership in the fund up for sale, and they can sell that off. Who gets to control the price? Who gets to control the marketing? Who gets to determine whether they want to sell it after 10 years or at the end of a longer period of time? Again, these are all issues that should be thought of and planned for and put into the agreement at the time that the money is invested into the Opportunity Zone Fund. And I'm sure we're going to come up with some more examples, maybe some more elegant solutions, things where investors may have less or more control in the project, or the project managers have less or more control. But we want to know where that power sits, who has control of when the action is going to occur. Then one of the questions that has come up, particularly with regard to real estate projects, but it also applies to businesses, is there any way that a project can be designed that would help influence the market, that is, to improve the likelihood of success of the project or enhance the value of the project, and try to time that to match the 10-year or later exit point on this particular project? And there are a lot of different things that are now being discussed that could de-risk a project, that might prevent this from being a wide open market volatility type of thing, so that this project has a higher chance of success. So right now we're doing discussions on a number of projects about putting in what would amount to be a private economic development activity to the side, something that would serve to increase economic activity within the project itself, or to increase the number of tenants, or to keep these buildings full over time, so that we don't see a bubble and then a decline on the backside. We see something that is a steadily rising and then maybe hopefully reaching early and full occupancy of a project and staying that way over an extended period of years. And so what would that look like? And there we're talking about recruiting new businesses in, similar to the manner in which an economic development agency would recruit a business in, trying to assist the businesses in succeeding, which would be like a Chamber of Commerce or an SBDC. What can we do to arrange funding for the businesses that come in, so that they have more of the resources they're looking for? What can we do to help with training, health, other things that may be there, so that the business actually wants to be in this location, they want to thrive in this location, and this carries them out over a long period of years, so that when you get to the exit point, everything is in its optimum condition. So this is an area that's getting a lot of discussion right now, and we're looking at different designs that would have this ongoing ability to influence the market in the locale of this specific project. Now, clearly, if you have a massive national type of economic collapse, you may not have as much influence as you would like, but we've seen here in Denver that Denver often is counter-cyclical to national economies. It was one of the lowest, it took one of the least hits in the last recession, and it bounced back quicker because we had a more resilient economy and people preferred being here over other locations which were hurt worse. So these are things that might be looked at depending upon the size and scale of the project. What can you do to influence the exit, to de-risk it, to improve the likelihood of success?